Canopy Growth Corp is trading live at $1.15 per share, showing a significant intraday spike of 5.50%, or about 6 cents. Now, on the surface, a 5.5% move on a low-price stock might seem like just another day of noise in the volatile cannabis sector. Many will see this pop on their Robinhood app or SoFi Invest platform and chalk it up to speculative chatter or a sector-wide sympathy move. The broad expectation for a stock like Canopy Growth is that it's a binary bet, a long-duration lottery ticket waiting for one specific event: comprehensive cannabis reform in the United States. The common belief is that nothing else really matters, that you just buy it, stick it in your individual brokerage account, and wait for that one legislative catalyst to send it soaring. But that expectation glosses over a far more immediate and complex reality. This 5.5% move today, and the trading action we've seen all year, isn't just about that distant hope. The reality is that Canopy's survival and current valuation are being dictated by a much more tangible day-to-day battle with its own balance sheet, its convertible debt covenants, and a grueling operational restructuring. The real story isn't Washington. It's the company's desperate and ongoing effort to stay solvent long enough to even see the day reform arrives. Let's dissect this recent price action, because it's far more instructive than the headlines. A 5.5% jump needs context. Is this on high volume? Is this a short squeeze? Or is this just thin, algorithmic trading moving a low-priced name? Often with Canopy, you'll see these sharp moves on surprisingly low volume, which tells you that large institutions aren't flooding in. This isn't like Nvidia stock, where a 5% move involves tens of billions of dollars changing hands. This is a different kind of market dynamic. The investors active here are often retail traders using platforms like Robinhood stock trading, or more sophisticated high-frequency traders using interactive brokers' terminals. They're playing the micro-trends, rumors of an asset sale, chatter about debt for equity swaps, or minor regulatory shifts in secondary markets like Germany. The average person looking for online investment opportunities, perhaps using a service like Schwab Intelligent Portfolios, is being guided away from this kind of volatility. Those automated intelligent portfolio systems are built to avoid companies with this level of cash burn and balance sheet distress. This is the playground of self-investing enthusiasts who are willing to take on immense risk for a potential, though highly uncertain, reward. The expectation is that this is a simple buy and hold. The reality is that this is a trader's stock reacting violently to news that most long-term investors wouldn't even know how to interpret. The broader market narrative for cannabis has been brutal. We've watched these stocks collapse 90–95% from their highs. This has tested the patience of everyone, from the newest SoFi investing user to seasoned veterans. Canopy Growth, once the darling of the sector with a multi-billion-dollar investment from Constellation Brands, has become the poster child for this value destruction. The common narrative is that they simply spent too much too fast, acquiring assets around the globe in a land-grab strategy that proved disastrously premature. This is largely true, but the current reality is about what's left. The company has been in a perpetual state of strategic review, which is corporate speak for selling everything that isn't nailed down. They have exited operations, laid off thousands of staff, and consolidated facilities just to slow the rate at which they burn through their remaining cash. This 5.5% move today might be a reaction to a new analyst note, but it's more likely a technical bounce off a recent low, or a slight easing in the credit markets that gives them a few more days of breathing room. It's almost certainly not based on a fundamental improvement in their core Canadian cannabis business, which remains a low-margin, highly competitive, and over-regulated slog. Many investors using Fidelity investments for their long-term goals, perhaps in Fidelity mutual funds or Fidelity ETFs, would never dream of touching this. A Fidelity brokerage account gives you access, but the Fidelity wealth management advisors would likely caution against it heavily, steering you towards more stable assets for your Fidelity IRAs. So, what does Canopy Growth actually do? For those new to the name, this is a Canadian-based producer and retailer of cannabis products. They were, for a time, the largest cannabis company in the world by market capitalization. Their business model was predicated on three pillars: dominating the Canadian recreational and medical markets, establishing a global footprint for medical cannabis, particularly in Europe, and, most importantly, creating a complex and expensive set of options and agreements, like with Acreage Holdings, Wana Brands, and Jetty, that would allow them to enter the U.S. market the moment it became federally permissible. This last part is the Canopy USA strategy, a structure designed to hold these U.S. assets at arm's length to avoid delisting from major U.S. exchanges. This structure itself has been a source of immense controversy and confusion, highlighting the challenges of online investing in a sector where the regulations are a patchwork of state and federal laws. It's a far cry from the relative simplicity of buying Apple stock or even a volatile name like Tesla stock, where the business model, while forward-looking, is at least legal and straightforward. This complexity is why investment help is so critical in this space, yet many retail investors on investing sites are navigating it alone, drawn in by the Robinhood fractional shares that make a low-price stock feel accessible. Now, let's look at the future outlook, framed by this constant tension between expectation and reality. The grand expectation is simple. The U.S. government reschedules or deschedules cannabis. Canopy USA's options are exercised. Canopy Growth becomes a dominant coast-to-coast player in the world's most lucrative cannabis market. The stock goes from $1.15 to $15, $30, or $50. This is the narrative that keeps the hope alive. The reality, however, is fraught with risk. First, let's talk about the biggest risk: dilution. Canopy Growth has been kept alive by its financial lifeline, Constellation Brands, and by repeatedly selling new shares into the market. This is an at-the-market offering. Every time they do this, the existing shareholders' piece of the pie gets smaller. That $1.15 price tag is partly a reflection of a ballooning share count. They are funding their losses by diluting their most loyal supporters. Second, the debt. The convertible debt, much of it held by Constellation, hangs over this company like a storm cloud. The terms of that debt have been renegotiated, but they remain a significant burden. This is the financial engineering that active traders on Interactive Brokers platform are watching, not the latest product drop. A failure to manage this debt could wipe out equity shareholders entirely, regardless of what happens with U.S. legalization. And third, even if U.S. reform happens, the reality may not match the expectation. What if rescheduling to Schedule 3 is the outcome? This is a positive step as it would remove the crippling 280E tax burden, but it doesn't solve the core problem of interstate commerce. And it doesn't give companies access to major exchanges or banking services. It's a partial win, and Canopy's entire U.S. strategy is built on a full, comprehensive victory. This is the nuance that gets lost. Here's a question for everyone watching. Do you believe the U.S. government will pass any meaningful cannabis reform before the 2026 midterm elections? Let me know your honest take in the comments below. Furthermore, when we talk about catalysts, Germany is a real one. The recent liberalization of cannabis in Germany creates a tangible market for Canopy's established European operations. This is not a maybe catalyst. This is a real developing market where Canopy has a first-mover advantage. This is, frankly, a more solid and immediate catalyst than the U.S. reform dream. The company's recent focus on an asset-light model, moving away from owning massive cash-draining cultivation facilities, is also a positive development. It shows a management team that has finally accepted the reality of the Canadian market and is focusing on survival and higher-margin products. This is the kind of strategic shift that might, over time, attract a different kind of investor. Someone who is looking for a deep-value turnaround play, not just a legislative gamble. This is the kind of detail you look for when you're doing your own self-investing, whether you're on the Fidelity mobile app or the SoFi trading platform. But let's be clear, this is not an investment for the faint of heart. The risks are enormous. Competition in the U.S., even if they enter, is fierce from multi-state operators who are already entrenched, profitable, and battle-hardened. Canopy would be entering that market as a late and still cash-burning entrant. This isn't a stock for a Fidelity IRA or a Robinhood cash management account. This is speculative capital. It's the kind of holding that you can trade actively on a platform like Interactive Brokers, which is designed for high-volume, high-risk Interactive Brokers stock trading with its famously low Interactive Brokers fees. For the average person looking to invest online, this stock represents a monumental risk. So, as we watch Canopy Growth sit at $1.15, up 5.5% on the day, let's put it in perspective. The expectation for this stock